The collapse of 2030 did not begin in 2030. It began quietly. Without headlines, without panic, without sirens. It began the moment the world convinced itself that endless growth was normal. Every major collapse in history starts years before anyone gives it a name. In 1929, the Great Depression began long before Black Tuesday. It began when leverage became ordinary, when taxi drivers discussed stocks, when borrowing felt safer than saving. In 2000, the dot-com crash began long before the Nasdaq peaked. It began when profits became optional, when valuations detached from earnings, when hope replaced math. In 2008, the financial crisis began long before Lehman Brothers collapsed, when risk was sliced into securities and labeled safe, when debt disguised itself as prosperity. And now, the collapse of 2030 may have already started, not with a crash, but with a condition. A global system stretched to its psychological and financial limits. Look around. Global debt has reached levels that would have been unimaginable a generation ago. Governments borrow not for emergency, but for normalcy. Budget deficits are no longer temporary measures. They are structural features. The bond market, once the anchor of stability, now reacts violently to the smallest policy signal. Yields rise. Governments pay more to service old promises. The cost of yesterday's spending compounds into tomorrow's constraint. This is not dramatic. It is mathematical. Every empire that relied too heavily on debt believed growth would outpace obligation. Growth always slows eventually. The question is what happens when it does. At the center of the modern financial system sits the Federal Reserve and its global counterparts. After 2008, central banks rewrote the rules. They injected trillions into the system. Markets adapted to a new environment, liquidity as a permanent safety net. Then inflation returned, and the safety net became tighter. Higher rates exposed vulnerabilities hidden during the era of cheap money. Corporations that thrived on low borrowing costs began refinancing at painful levels. Commercial real estate markets weakened. Consumers carrying record credit balances felt pressure building month by month. Nothing collapses all at once. It erodes. Consider the stock market. A handful of mega-cap companies dominate index performance. Passive investing channels trillions automatically. Concentration risk grows quietly in the background. If confidence shifts, the structure could amplify volatility at digital speed. History has seen concentration before. In 1929, it was industrial giants. In 2000, it was technology darlings. In 2026, it is artificial intelligence infrastructure and platform monopolies. AI is transformative. It may redefine productivity, labor, and global competition. But transformation and valuation are separate forces. In 1999, the internet was real. The bubble was real too. The same question hangs in the air today. Are expectations outrunning timelines? Meanwhile, geopolitical tension redraws the economic map. Supply chains fragment, trade blocs harden, sanctions become strategic tools. The idea of frictionless globalization fades. Economic warfare replaces open integration. When the world economy becomes less cooperative, efficiency declines, costs rise, margins compress, growth slows. Slow growth and high debt rarely coexist peacefully. Another fault line lies beneath demographics. Aging populations in major economies strain pension systems. Fewer workers support more retirees. Productivity must accelerate just to maintain stability. If growth disappoints, fiscal stress multiplies. Again, this is not dramatic. It is arithmetic. The collapse of 2030 may not look like 1929 or 2008. It may be a slow grinding reset. A banking liquidity crisis. A market correction. Each event manageable in isolation. Dangerous in combination. Financial systems fail when shocks overlap. When trust thins. When investors begin asking questions they once ignored. Is sovereign debt sustainable? Is fragmentation permanent? The collapse may have begun when those questions became uncomfortable. First comes normalization of extremes. Debt levels that once shocked now feel routine. Valuations feel justified. Then comes dependency. Markets depend on stimulus. Governments depend on borrowing. Consumers depend on credit. Dependency reduces resilience. The collapse of 2030 will likely be about the architecture of the entire system. Not one bank, not one country, but interconnected fragility. Technology accelerates this fragility. Digital bank runs can happen with a tap on a screen. Confidence once took weeks to erode. Now it can fracture in hours. And yet, there is another possibility. The world may adapt. Productivity gains from AI could offset decline. History offers warnings, not guarantees, but one pattern remains consistent. The greatest risk periods are those of maximum confidence, when volatility is low, when headlines are optimistic. In 1928, optimism was unshakable. In 2006, housing felt invincible. Today, resilience is assumed. But resilience is tested, not declared. The collapse of 2030 may be a credibility crisis, a moment when investors question whether debt can be rolled, when voters resist austerity, when markets demand risk premiums. It will feel sudden, but it will have been building for years. Just like before, there is a final layer: human memory. After every crisis, safeguards are strengthened. Then, caution fades. New generations enter with no memory of collapse. The seeds of 1929 were in the 20s. The seeds of 2008 were in the liquidity of the early 2000s. The seeds of 2030 may be in the recovery, the AI boom, and the normalization of trillion-dollar deficits. Collapses are about accumulated assumptions. Assumptions that growth will remain high, that rates remain manageable. When enough assumptions prove fragile, systems reset. The year 2030 is symbolic, a horizon. A point far enough to feel abstract, but close enough to feel plausible. It is visible in rising fragility, in rising debt, in rising fragmentation. The true warning sign is not panic, it is complacency. Complacency allows imbalance to grow quietly, and imbalances do not disappear, they compound. The collapse of 2030 may arrive under a different name, but the cycle is not broken, it has evolved. Somewhere inside today's optimism, tomorrow's correction is forming, steadily. History repeats on psychology. Psychology has not changed in 100 years. The question is, will we recognize the early stages, before the word collapse becomes unavoidable?